Now, if you're choosing a broker, you have to be careful what broker you choose. You need to, there's some guidelines. First, you need a broker that's CFTC registered, which stands for Commodities Futures Trading Commission. You need to make sure that they have good spreads, meaning that the difference between the bid and the ask price is not too wide. It's very competitive. Different brokers have different spread prices. You want a broker that will execute a margin call, a broker executed margin call. This will keep you from losing more money than you have in your account. Basically, a broker executed margin call is saying that if you have a trade position that you're holding with them and the market takes more out of your trade than you have in your account, before that happens, they will take you out of the market automatically. This is a good thing. Liquidity, you want to make sure they have plenty excess net capital. Also, it's good to have a broker who allows you to make hedge positions where you are both long and short in the same currency pair at the same time. Later on, you'll see how this is an advantage to you in trading. Putting your orders in are basically three types of general orders. Market orders, which are orders you place that say, I want, just give me whatever the market is, wherever the market is at right now, that's what I want. Or you could put in what's called a stop order, saying that if price reaches this point, I'm out or I'm in, as well as limit. It's just they're saying the same thing, but just from different perspective. A limit would be where the price is, say, at 100, and I want to buy. Well, if the price was at 100, and I don't want to buy unless it reaches 90, that's a limit order. If I wanted to buy with a buy stop order as opposed to a buy limit order, and the price was 100, I'm saying, well, you know what? If the price goes past 105, I'll buy. And I'll buy it at the market price. Once it passes 105, whatever it goes past that, at that point, I'll buy. So that's a buy stop. If I was selling with a sell limit, I'm saying that I don't want to sell until the price reaches, say it's at 100 again. I don't want to sell unless the price reaches 108. And if it reaches 108, I will sell. There's reason for doing these various things, as you will learn as we go along. Let's try and get a little closer example. And once again, the market order, just to make sure you understand, is saying whatever the market is at, the market's at 102, okay, fine. I'll buy or I'll sell or whatever it is that I'm doing at the market order. Let's take a close look here at stop order positions. The buy stop order. This is an example of the buy stop order. What's happening here is we're looking at the market and we see that it's starting to go up again. So now, if the price reaches past this point that the red arrow is at, of say roughly about the 65.36, if the market passes that point, I want to buy. I'll buy the market price 1 over the 65.36. This is called a buy stop order. Let's say we have a sell stop order. Let's say that the market is going up, but we think that it's exhausted and it's about to roll back over. Well, we want to do a sell stop. We'll sell if the market falls below the low of this point here at 61.60. So we'd sell when it's reached 61.59. Now, stop order as well can be used as a stop loss. We'll take the exact same place at the 61.60, but this time it's under the guise that we have been buying and the market has been going up and we've made a good profit at this point, but we want to protect that profit, so we put in a stop loss order that falls anything underneath the 61.60. We want to end our position and take our profit and walk away and go home. This is called stop loss. And it's literal, stop any loss. Limit orders work like this. Let's say that the market's falling and we're up here near the top, and we can see in our market analysis that once the price reaches a certain point, it'll probably be at the bottom and we can expect it to turn back around. This is called a limit order. So we put in this limit order at 68.63. The price hasn't made it down there yet, but when it does, it will fill our order to buy. This is a limit order to buy. So we buy at 68.63. Of course, we have to put in a stop loss to protect ourselves from any substantial risk. So we would do that at roughly 67.98. As you can see, the price only made it to 68.24, so the stop loss would not get filled. We would still be long buying from our 68.63 position. And then when the prices reach the 70.34, we have a limit order to sell waiting to give us our profit of 171 pips. And this is how a limit order would work. And it works both ways, long or short, buying or selling. This could be in a complete reversal. Let's put it all together in security and money management, because this is very important. What we've just seen is how money management works, in a sense, a very base or very elementary form. And it's still very powerful. We have the entry and the exit. The entry being the limit, the stop, or the market order, and the exit being either a stop loss or a target limit. Let's get into the details of this real quickly so that you can fully understand. Here in this limit order example that we just saw, you had an entry, and the stop loss was based on money management, which we'll get into in a moment. So I put a stop loss saying that I will only risk so much money, which would be at this point. And as you remember, the market only made it this far. And at the same time that we put in this limit order to buy and this stop loss limit that we set, based on the amount between here and here, we determined where our position to take a profit would be, which was up here. And based on market analysis in this chart, it's logical that price could come back to this point because of what we have in our market analysis, which we'll learn about all of that later. But that's called the target limit exit. So this is where we take our profit. And as you can see, the market comes right back to it, turns over for a while, probably because a lot of people were taking limit order targets here. And this is where we get our profit. So this is a form of money management, saying that I will only risk so much, and for everything that I risk, I look to gain a certain profit. Now, let's get into this a little deeper. The security in money management is very powerful. Again, the entries and exits are determined by a profit-loss ratio. When market analysis tells us it's time to make a trade, we verify that trade profit potential with its ratio, as we saw in the previous screen where we said we'll only risk this much because we're expecting this much. These are the ratios. Ratios go in either 2 to 1, 3 to 1, 4 to 1, 5 to 1. We favor the 3 to 1. We liked that one an awful lot, so we'll use it as an example. A 3 to 1 ratio would be for every pip of risk, or where the stop loss is, I'm going to take a target limit to say I will take my profit 3 pips. So for every 1 pip I risk, I'm looking to gain 3 pips. Okay? Here's a table showing this. Let's say that you have $1,000 in your account, and roughly you trade 1 trade per day or so. So that would be roughly about 20 trades per month, and that's what we have over here in the trades, where you see 20 here. So then with $1,000, a 3% risk would be about $30. And let's say that in your market analysis you have about 50-50. Half the time you're right, half the time you're wrong. And let's say you have a ratio of 2 to 1 that you're using in your money management. What this would mean at the end of the month would be an income of $300, because half the time you lost, meaning $300. Half the time you were successful, meaning 600. You subtract 600, 300, you get 300. Very simple. The greater your accuracy, the greater your income at 2 to 1. And the same thing if it was 3 to 1. Same thing happens. You increase the income along with your ratio, or your accuracy. Here's an example. I really need to show you this because it's extremely powerful. Money management is essential in making profit. Okay, it's not just your market analysis. The security that you have in money management works like this. Say you have a $300 account, small account. This means you can only risk $9 maximum, 3%. Well, if that's the case, at a 3-to-1 ratio, you would risk $9 for a $27 reward when you trade. Let's say that in a month you trade an average of 1 per day. That's about 20 trades per month. And let's say that you're terrible. Your market analysis really stinks. You only have 30% accuracy, meaning that 7 out of 10 times that you trade, you're losing. You bomb out. You can't seem to do it. Actually, with a 30% accuracy, you need to go back to the drawing board. You need to study. You need to do some homework. Okay? But even still, let's say that that's your average of 30% accuracy. What that would mean is that you would have, out of the month, 14 losses at $9. $9 times 14 losses would equal $126 in losses versus $27 in gains of 6 wins or 6 successful, profitable trades would equal $162. Now, because of the money management rule that you're using, would mean that even though you're only right 3 out of 10 times, you have a $36 profit at the end of the month. That's a 12% monthly gain on your $300 principal. How many people would love to have a 12% monthly gain on their principal? They would be happy with 12% a year. You take a 12% monthly gain, compound that by every month, you're well over 100% interest on your principal at the end of the year. Wouldn't you like that? And you're only right 3 out of 10 times. You're really not very good at market analysis, but because of money management, you still find yourself doing well. Very powerful thing in trading, whatever you're trading. Next step is knowing, we're getting back to market analysis now. There are things that you need to know in market analysis. Basically 2 things. The first thing is knowing the market's direction or its trend, whether it's bullish going up or bearish going down. The next thing is knowing what levels to enter and exit at. I'm really breaking market analysis down into some very simple terms, but it's to help you get an understanding. You have to know the market support and resistance levels, not just whether the market is trending up or down. You need to know, well, where is support and where is resistance? Support is price levels that are near the bottom, so they support price, so that if they reach a support level in an uptrend and they fall back to a support level, the support level should push the price back again to the upside, the bullish side. Resistance is a price level at the top of a range. So if you're in a downtrend, a bearish trend, and prices begin to rise against that bearish trend, when they reach that resistance price level, it should push the price back down again. Good market analysis, along with good money management, will always equal profit. So if you know what your trends are, whether they're up or down, and you know where your support and resistances are, that's part of being able to have good accuracy, and then including money management will give you profit. Your next lesson will be identifying the trend, obviously, after we've discussed this. So let's move on to Trend ID 101.